All right, guys. So we're gonna get started here with EXP Military Network. My name is Silas, Air Force veteran, and I'm gonna be hosting today alongside with Nathan Wheeler. He's gonna be talking about wealth and taxes, and so I don't really want to take up all his time, so I'm just gonna let him jump in and take it over.
Well, I appreciate that. Thanks. And yeah, kind of the goal today is talk about how does money grow? How are we taxed on that growth? And what does it look like to actually plan financially? Like, how do we do that effectively? And so before I dive into anything, I'll just share a little bit of background about some of who I am and things that I've done and kind of why I'm here. So obviously name's Nathan Wheeler. I was active Army for about 11 years. I wrapped up my career with 10th Special Forces Group out here at Fort Carson in Colorado. So I had a pretty good go. After getting out, I did what a lot of us do. Initially I just went back to contracting. I went back to Afghanistan initially on a special operations joint task force, came back stateside, started training the military in different capacities, first with Army Strategic Command, and then I did something similar for the Navy. And then I was asked to develop and facilitate the senior leader courses for the United States Space Force, which was a unique opportunity. I was an enlisted soldier, so I found myself in rooms that I never really planned to be in. But it was good. And we got those programs off the ground. I went to work at one of our combatant commands in the J35, writing the campaign order, just outlining to the branches of the military how we're going to execute the national strategy. And then from there, I went to work with a company called Deloitte. And I had never heard of Deloitte until they offered me a job. Great organization, phenomenal leaders, and phenomenal leadership development. And I really took advantage of that opportunity and left to pursue a career here in financial services. And, I could have given you a million scenarios of what I do when I grow up, and not one of them would have been financial services. But here we are. And kind of what led me to be in this space is, back when I was in the military, I was saving in a TSP. I was losing money. I had less money at one point than what I had put into it. And I was like, hey, this is not sustainable if it's what should allow me to live comfortably for the last third of my life without a job. And so I sat down with some professionals just to learn about money. And get a better understanding of the different ways that we can strategize wealth. And so as I did that, I just learned. I learned a lot about what we don't know because there is no financial education in this country. I mean, less than 14% of high schools offer any type of financial education. So we graduate high school, enter into the workforce, start making money, and we don't know what to do with it. And so all of what I'm saying just led me kind of down this path. And so initially, again, back when I was in the Army, I started saving differently. Now, after about 6 years, I realized the significance and legitimacy of what I was doing and really gathered a lot of information, again, about the fact that most people are just shooting in the dark, right? They don't have a plan. They're not actively planning for retirement. They're not actively planning for wealth accumulation or generational wealth. We're just going to work, making money so that we can live in the now. And so all of this, again, after about 6 years, all of this led to me getting licensed within this industry so that I can help people. Now, initially, when I started here, I had no intent to change my career. I was at the pinnacle of what I thought. Again, working on a 4-star staff, just doing a lot of good stuff in that space. And I thought that that's kind of where I would end up. I was making more money than I thought I'd ever make. Like, it was good. But when I got licensed, started helping friends and family, a few things happened that really shift the narrative for me. Number one, I just saw the amount of people that needed insight into this space. Number two, I started learning about the transition of wealth that we're experiencing right now, which some of you may or may not be familiar with. Like right now, we are experiencing the greatest transition of wealth in the history of our country. And that's because the baby boomer generation is dying and retiring. There was like 78 million people born in a decade. And every industry they've touched, it's exploded. And now they're dying and retiring. So it's the wealth transition phase. And so I realized the need for this, but because of that too, we are seeing we have less financial professionals. We don't have enough financial professionals to help 1% of the population because again, they're typically older and they're retiring, they're getting out of that business. And so we need somebody else to kind of come and take the torch. And so I was down to be that person, right? And that's kind of why we're here, right? As I started moving into this space, and again, helping friends and family, I started outpacing my salary and realized like, hey, this is something that not only do I get fulfillment from, like I enjoy what I'm doing, but I can also provide for my family. And so that's why we're here. At this point, I run a nationwide brokerage. We got about 200 associates across the country. We have direct contracts to the top 192 providers in the industry. We have CPAs, attorneys, both estate and tax attorneys. We've got investment advisors, insurance professionals. Like we really brought together a conglomerate of professionals to make sure that as we do what we do, we're looking at the big picture. And so that's where the insight that I'm going to share with you today is coming from. Like, it's not just some random dude sitting in a chair, in front of a wall. Like, I've got some experience within this space. And so I want to make sure that people really understand the fundamentals. How do we actually play the game? Because It's important to understand the rules of the game so that you can play to win. So that's what we're going to talk about today. I'm going to share my screen and I'm going to dive in. I know we've got a few people here live with us, guys. If you get the recording, I'll make sure you have some kind of contact information. If you just want to hit me up, chop it up a little bit, ask some questions. If you're here live, please feel free. We've got a small enough group. Just come off mute, ask a question. Let's talk a little bit. Now,
Absolutely. Thanks.
yeah, my pleasure. And so just kind of some of the things that we're going to go over. Initially, I want to talk about compound interest and the rule of 72. We'll talk again about how money grows and how money gets taxed, how that growth gets taxed. And then I'll talk about the 6 steps to financial planning that we typically take here. And so I always like to, I always like to start with compound interest because it's kind of foundational when it comes to understanding wealth strategy and how we can grow our money. And so compound interest is pretty simple. What it does, it's a term that we use to describe the money that we're saving and the interest that we're gaining, continuing to grow uninterruptedly. And that's kind of that most important component. It's that uninterrupted growth, because the minute that we experience some sort of loss or depreciation, we are no longer compounding interest and we have to spend time rebuilding to get back to where we were. Right. So every time negative interest is applied, so if your money's in the stock market, a 401k, like an IRA, every time that there's negative interest applied, we have disrupted the compounding process and we have to spend time rebuilding to get back to where we were. Now, here's the thing about compound interest. It's either working in your favor or it's working to your disadvantage. It's kind of that simple, right? Like if you're using compound interest on a credit card or a loan and it's working against you, then it's gonna kind of eat up. You're gonna pay a lot of money in interest. But if you're using it to your advantage, then your money can grow exponentially. Your money can appreciate at a pretty significant rate, and that's where the rule of 72 comes in. This actually tells us about how long it will take for our money to double based on the interest rate that we are earning. Now, this is kind of important because this is something that I learned in my 2nd degree program. So it took 2 degrees of higher learning, and it was actually made famous by Albert Einstein, which is significant because when we think of him, we think of the theory of relativity, which I've never had any use for. But understanding the rule of 72, it can actually help you, again, understand how to strategize well. And so it's pretty simple. You take 72, divide that by whatever interest rate you are earning, and that is about how long it will take for your money to double. So for example, if you have your money sitting in a bank account, and let's say it's just getting a 1% return. And by the way, that's a bit of a stretch. According to the FDIC, on average, bank accounts are giving about a 0.46% return. But we're going to keep the math simple. And let's just say it's a 1% return. 72 divided by 1 is 72. So that means it'll take about 72 years for your money to double. And obviously, if you have your money sitting in a bank account, you're probably never going to see your money double. But if we're getting like a 12% return, 72 divided by 12 is 6. So now your money's doubling just about every 6 years. Right. And so, again, it's important to understand this concept because it is foundational and it helps people not only understand, compound interest and how it works, but also why it is so important to fight for every percentage point while we are building wealth. Now, Albert Einstein, like I said, he mentioned that compound interest is the 8th wonder of the world, right? He said, he who understands it earns it and he who doesn't pays it. And that's kind of what I was alluding to earlier, right? If you understand how you can use it to your advantage, you will, and it'll be beneficial for you. But if you don't, then you'll be paying it again in the form of different types of loans and things of that nature. And so understanding this concept can help you strategize just a little bit more effectively. But I want to dive a little bit deeper and talk about how money grows, right? There are 3 ways that money grows. And here's the thing. There are thousands of accounts that we have access to in the United States of America, right? A lot of people are taught to put their money in a bank or a 401k. But again, those are 2 of thousands of accounts that we have access to. All of them, though, they grow in one of 3 ways. In a fixed account, you get a fixed rate of return. It's usually between 3 and 5%. And these are like savings accounts, certificates of deposit. These are money market accounts. And so the benefit here is that your money, it's usually safe and easier to access. But the downside is these accounts don't typically keep up with inflation. So you're actually losing buying power, right? Your money is safe here, but it's not growing in a way that keeps up with the real world. Now, then we have variable accounts. And here, We're just betting on the success or failure of a company, right? Quite literally, these are stock options, 401ks, IRAs, these are mutual funds, these are brokerage accounts, cryptocurrencies. And we put our money with a company, and then they leverage that money to go and do some research and development and stay competitive in their market. And if they do well, they're going to kick back some gains to us. And if they do bad, then we're going to realize some loss. So the thing is, you can do very well when the market is up in a variable account. I'd say one of the challenges here is, they have to be actively monitored. They have to be traded and moved around. You're supposed to buy low and sell high. And if you're not paying attention, you're not playing the game effectively there, then the downside is you can lose money, right? And when you do, you've disrupted the compounding process. And then you have to spend time to rebuild to get back to where you were, right? One of the examples that I like to use is, if you have $100 and you get a 50% return, you'll be at 150, right? But if you go down 50%, you're not back at $100, you're down to 75%, right? Because 50% of 150, 75. And so kind of understanding that concept, it'll help you understand, like, okay, when we are in the variable market, how are we actually playing? And what does it look like when we have to rebuild? On average, it takes about 4 years to bounce back from a 20% depreciation, which most accounts realized back in 2022. So here, again, in these variable accounts, there's potential for greater returns, but there's also significant risk of loss. Hopefully I'm making sense here. And I know we've got a few people on the call, but if you have any questions, like, please do not hesitate to raise your hand and just chime in and ask, right? Hopefully there can be some dialogue here. Now, then we have indices and index strategies through insurance companies, right? And so when I'm talking about an index in finance, that's just a group of companies. And can you guys still see my screen? It just kind of went weird too. Okay. Looks like we're good.
We're good.
So
I can see that.
Perfect. The little green border around it just kind of disappeared. So I just want to make sure technology isn't technologying. So with an index, again, in finance, that's just a term that we use to describe a group of companies. This is like the S&P 500. This is the NASDAQ, the Dow Jones, and there's so many indices out there. But again, it just describes a group of companies. And so instead of relying on the performance of one company, the performance of our portfolio is based on the average of an overall group of companies. So I'll use the S&P 500 as the example here. The S&P 500 is the top 500 publicly traded companies in the United States of America. And the gains or losses that we experience, they're based on the average of those 500 companies, right? And the S&P 500, it's averaged about 10% annually. Studies show, as a matter of fact, that it outperforms over 90% of professional money managers over time. So that's strong long-term growth. Here's the problem. If we invest directly into an index, it is still variable. You can still lose money in the bad years. The S&P 500 closed out at about negative 20% in 2022, and we've seen depreciation over the years at different times, again, including 2008, which some of you may be familiar with. That was a pretty heavy-hitting year for a lot of folks. Now, the difference with index strategies is that we are insuring our money through insurance companies. They allow us to realize the gains based off the performance of a market index without our money actually being in the index. So if the index goes up 10%, we're going to make 10%. If the index goes down 10%, we're locked in. We're not going to make money in the negative years, but we're not going to lose any money either. So we're backed and guaranteed by the insurance company to never lose money. And it's one of the only ways to participate in the upside of the market without taking on the downside risk. Now, that being said, there's a time and a place for each of these types of strategies, right? It's just important to know when to leverage which. Fixed accounts are great for emergency savings, and variable accounts, they can be powerful when actively managed. Index strategies are ideal for people who want growth, compound interest, and protection all in one place. Now, all that being said, equally important is understanding how we are taxed on the growth of our money, right? This is very important. I want to paint a picture right here real quick for you, because right now we are $38 trillion in debt as a nation, 38.8 trillion. As a matter of fact, I haven't checked in a few days. We might be at 39 trillion at this point. That number is unfathomable. And here's the thing about the national debt. It's been doubling every decade for the past couple of decades. We hit $10 trillion in national debt in 2009. In 2018, we hit $20 trillion in debt. Here we are in 2026, and we're at 38.8 trillion. So I'm fairly certain that by the time we get to 2028, we'll be at $40 trillion in debt. And the reason that I'm kind of hitting this point is because I want you guys to consider this for a second. Who do you think is going to pay that off? Who's responsible for that? It's the taxpayer. It's me. It's you. It's everybody that we know. So understanding how and when we pay taxes on what is an essential component of financial strategy. It's just that simple. And so there are three ways that we're taxed on the growth of our money. In a tax now account, we use after-tax dollars to save in things like bank accounts, brokerage accounts, mutual funds, certificates of deposit. And then you're taxed again on any interest, dividends, or capital gains. So we're being taxed twice. Now, the real problem is that when we tax the gains each year, you don't get the full power of compound interest. Think about this. If you have $1,000 and you get a 10% return, the gains are $100. And if you have to pay 20% taxes on those gains, then instead of moving forward with $1,100, you only move forward with $1,080. And over time, that can reduce your long-term growth. Now, then we have your tax later or tax deferred strategies. These are things like 401ks, IRAs. These are TSPs. These are 403bs, 457s, your traditional retirement accounts. And so with these, the money that we contribute is tax deductible. So if you made $50,000 and you put $5,000 into a 401k, the IRS only taxes you on $45,000. That $5,000, that then goes into an account and grows tax deferred, meaning you're not going to pay taxes while it's growing. Instead, you'll pay taxes on your contributions, any employer contributions, and the gains when you pull that money out at whatever tax rate the government has in force at that time. Now, here's the thing. These accounts are subject to the 59.5 rule, which means you can't touch that money until you're 59.5 unless you leave the company that holds that 401k or you prove significant hardship to the IRS. Either way, that money will be taxed as income, and there will be a 10% tax penalty placed on top of it. So again, I would encourage you to ask yourself a question, and that is this. Do you think taxes are going to go down, or do you think they're going to go up? Here are some things to consider as we analyze the answer to that question. The highest taxes that have ever been in this country was 94% in 1944 during World War II. So when we look at the current state of affairs globally, coupled with the US economy, I think it's fair to assume that taxes will likely increase. And what we've seen happen is people save for their entire working lives. They have a larger sum of money that's taxed at a greater percent. So it's more of more. The real kicker is the fact that the deductions we typically claim are related to our mortgage, our children, and our business. When we're in retirement, our mortgage is usually paid off. The kids are too old to claim, and we're not in business anymore. We're in retirement. Now, I'm saying all this not to say that deferred strategies don't have a time and a place, but more so to implore the fact that you've got to be cognizant of that time and of that place and aware of when you'll bear the brunt of that responsibility. Now, then we have our tax advantage accounts, right? And these include Roth strategies, municipal bonds, cash accumulation insurance policies, executive bonus plans. And here we contribute after tax dollars. So we've already paid taxes on the money, kind of like a tax now account. The difference is we don't pay taxes again. We don't pay taxes on the gains, and we don't pay taxes as income when we pull that money out. So instead, we just pay taxes upfront from our current income when our money is the smallest and at a known tax rate. From there, that means we have a tax-free retirement supplement or tax-free access to capital for anything that life throws our way. Now, the outlier in this category is those Roth strategies. And I want to talk about that just for a second, because I realized, in doing this, not a lot of people are aware, but like with a Roth IRA, for example, you cannot touch that money for 5 years. If after that 5 years, you are under the age of 59 and a half, you can only access your contributions without a tax penalty. If you wanted to tap into the gains, that money would be taxed as income, and there would be a 10% tax penalty on top of that. Right? That's important to understand. Likewise, I think of consideration and relevance here with a Roth IRA specifically, you can only put in $7,500 a year unless you're over the age of 50, and then you can put in $8,600. Also, I think for the audience here, because I know some real estate professionals, you guys can make some pretty good money. If you are making too much money, you cannot contribute to a Roth IRA. There is something called adjusted gross income. And so when we're talking about the adjusted gross income, it limits the amount of money that we would be allowed to put into a Roth IRA. So I guess let me give you an example. If we have a Roth IRA and you are single, and let's say your adjusted gross income is $153,000, once you hit that threshold of $153,000, you would only be able to make partial contributions up until you hit $168,000 in income. At that point, you would no longer be able to make any contributions to a Roth IRA. Now, I don't want to dive too deep into the backdoor Roth or some other strategies, but there are things that we can do to potentially leverage that account still. But there are also other strategies that we can just leverage rather than playing the game with a Roth. Now, if you're married filing jointly, similarly, they have some thresholds, right? If you're making $242,000 a year, you can make partial contributions up until $252,000, and then you can make no more contributions, right? So anyway, I just want to throw that out there because I hear a lot of people talking about Roths and asking questions about Roths, and they can be phenomenal when leveraged appropriately, but there are some considerations that I think are relevant, right? Now, all that being said, if all we did, if all that anybody ever did was gather financial education and never actually implement those things, then they wouldn't create a healthy financial plan or strategy. And so there are 6 things that we typically look at, and that I would encourage you guys to look at, or if you're working with a professional, like just have the conversation about these areas so that we can bring the big picture together for a financial plan and strategy, right? There are really 6 major areas that we look at, and some people need help with one of them. Some people need help with all 6. Either way, I think a good place to start is with cash flow, right? Because if the goal is to save more money, then usually we've got to go and find it first. And so one of the biggest challenges that we see when it comes to cash flow is that people are living paycheck to paycheck, right? We live in a consumer-driven society. We're taught to spend first and save later. And most people, when later comes, they don't have anything else to save. So it's important to identify ways to break that cycle through budgeting, tax education, expense analysis. And in some cases, maybe it's just finding additional ways to generate income, right? The economy's not doing the best right now. I know a lot of people are, it's just a thing. And it's easier to do that now than it has been in the past due to some of the advent of technology. Now, when it comes to debt, a lot of people are drowning in consumer debt. In the military, this is something that we saw. It's almost predatory because they know we're getting paid on the 1st and the 15th. So they're coming. Hey, we'll give you a line of credit. Right. And so it becomes a never ending cycle. People have a lot of consumer debt. They have poor credit. And so there's ways to simplify things there. Maybe it's consolidation, right? Maybe it's refinancing, or maybe it's just restructuring debt in a smarter way, right? A lot of people, and I'll throw something out there, a lot of people tend to go after the lowest balance debt first, when in reality, in most cases, if you go after the highest interest debt, and pay that off first, and then continue to snowball to the next highest interest and so on and so forth, that will keep more money in your pocket because you'll pay less in interest over time. Now, when it comes to the emergency fund, this is kind of a big deal. Most Americans can't cover $1,000 emergency without going into debt, and that compounds the debt problem. And so it's important that when you go through that cash flow step, you identify money that can be redirected to build 3 to 6 months of an emergency fund so that unexpected events don't turn into financial crises. And I want to talk about that for a second, because sometimes people put a whole lot more than that in their like bank account. And so let's just talk about this for just a second, because wherever your money's at, if it's growing, like you're paying for something. So it's important to know what you're paying for. So even in an emergency fund, if you have a lot of money, like more than 6 months sitting in like a bank account. Well, in those cases, the gains that you're realizing aren't outpacing inflation. So the cost is the difference between inflation and the rate of interest that you're earning. And so having more than 6 months sitting in an emergency fund or a savings account, it's hard to justify because the bang isn't worth the buck. So have enough money to make sure you're taken care of. But outside of that, let's put your money somewhere where it's growing more effectively and outpacing inflation. Hopefully that makes some sense. Now, when it comes to proper protection, this is all about protecting assets, income, and livelihood. And most people don't have the right coverage. A lot of, especially if you're an entrepreneur, you don't have any coverage in a lot of cases. Most people rely on group insurance that they get through work, but those policies are often limited. They're not portable. They don't meet the insurable need and they don't require a qualification. So that means the employer owns the policy, not the insured person. And if the insurance company can find a pre-existing condition, in some cases, they won't pay out. I've seen it. That doesn't mean all the time, but I do advocate for independent insurance. I think that's important. So you can actually cover the insurable need, right? And it's important to find the policies with the best rates and features. And I want to highlight something here because a lot of people don't know this exists. So there's something called living benefits on some life insurance policies. And there are some companies who misrepresent the reality of what those are. They'll say they have living benefits because they have an accelerated terminal rider. When I'm talking about living benefits, I mean that some companies will allow people to access the death benefit of a life insurance policy while they are still alive in cases related to chronic, critical, and terminal illness, right? And the reason that that's worth like an honorable mention here is because, guys, the number one cause of poverty and bankruptcy in the United States of America is medical expenses related to chronic, critical, and terminal illness. And that's because when something happens, people liquidate their assets, they take out a second mortgage, they do whatever they got to do to either cover those medical expenses or to supplement their loss of income. And a lot of us, we probably got medical covered. I know, I'm 100% rated through the VA, so my medical is covered. The reason I have one of these policies in place for me is because if I'm unable to do the things that generate income for my family, I need to make sure that my wife is square. I need to make sure that she's good to go until she can, pick up the slack or find a way to generate that kind of income. And this is just, again, all financial planning and strategy. Now, look, when it comes to building wealth, this one's a big deal, right? Because look, the average 401k right now for a 65-year-old looking to retire in this country has about $270,000 in it. When we look at other retirement supplements added on top of it, the average is about $414,000. Guys, nobody can retire in this economy with that amount of money. Not to mention the fact that Social Security's future is uncertain. So when we talk about building wealth, it's all about identifying the financial independence number, right? Which is how much money you need to save to retire when you want with the income that you need. From there, you can build a strategy that focuses on smart growth, tax efficiency, and protection. Now, look, with wealth preservation, this one's big, especially with you guys in the real estate space, where you're helping people make the largest purchase of their life. And most people, they don't even have a basic estate plan. They don't have a will, a trust. They don't have a healthcare directive, no power of attorney. And that leads to confusion, asset loss, and long, expensive probate battles. So it's important to not only provide education, but access to financial, estate planning services so that we can help people keep taxes and legal fees at a minimum. And I think that's important. And here's the thing, when I talk about a will and a trust, I'm going to keep it in layman's terms, and I want to pre-frame this. I'm not an attorney. I work with a whole lot of them, though. And we actually, for everybody that we work with, they get access to a basic estate plan that covers a will, a guardianship designation, a healthcare directive, and a financial power of attorney at no cost, regardless of whether or not they become a client. So that's not a pitch. That's a resource. Now, when I think about a will and a trust, a will, I like to consider it as displaying the intent. This is what we would like to have happen, right? A will enter into the probate process, and it will experience loss due to taxes and legal fees. Now, a trust, I like to consider more so the execution of that intent. And a will actually goes into a trust. But a trust, is a separate entity. And that's really the only way to bypass probate, is to put your assets into another entity. But you'd be wise to have it be an entity that you control, ergo a trust. And then We place our assets within that trust. We maintain control of those assets while we're still here, and we appoint a trustee to execute our desires once we pass away. And again, they're not subject to taxes and legal fees. So very significant when it comes to planning, especially when it comes to real estate planning, because there's something called a step up basis, so that when real estate is passed on in a trust, the people who inherit that are not subject to the capital gains tax from the date of purchase, rather from the date of death of the person who had that trust. Hopefully that makes sense. If not, it's okay. You can reach out. We can chop it up. Now, here's the thing. Like when it comes to planning and look at these things, I would encourage you guys to work with a professional. And I'm not saying that has to be me, but we all get great at the space that we're in. You guys are experts when it comes to real estate, and there are experts that throw footballs and play basketball, and they're expert war fighters, and they're, expert professionals in different areas. It's no different when it comes to finance. There are intricacies within this space that are very relevant and will determine how your money grows and how it's taxed. And so working with somebody that can look at the big picture for you will only do you and your posterity a good service. And so I would encourage you guys to look at that. And as you're working with professionals, I've become favorable to those who have access to a broad swath of services, rather than somebody who's captive to an organization and limited to that company's products and services. So again, I would encourage you guys to just do your due diligence as you navigate this space and start to explore what it looks like for financial strategy. Just do a little bit of due diligence, right? And make sure that you're getting taken care of. Now, all that being said, guys, regardless of what it looks like for you, I would highly encourage you to find a financial professional, go through a financial analysis, get an idea of where you are and how it relates to where you're going. On average, I think like over 70% of the population has never had a financial analysis. That's crazy. That means people are just shooting the dark. They're just throwing their money somewhere, and there's not an active plan to get to where it goes. And so the point of this conversation today was just share a little bit of insight on, hey, how can we actually plan and strategize wealth? What can we do to protect that? And how might we want to go about that? I can be available to anybody. Please don't ever hesitate to reach out. Even if you're just, I can be a sounding board. It's all good. I don't compete with professionals in my space. I live by the law of abundance. There is no scarcity over here. So I'm happy to be a sounding board. I will give my number to the people who help facilitate this and my contact information. And please don't hesitate to reach out. I'm a resource for you.
That was a lot of good information. I know that I need it, so I'll be calling you for sure. But
Yeah.
Would anybody have any questions? Well, I have a question. So if somebody wanted to start, right, let's just kind of say we're in the very beginning phases where somebody has more, I guess, negative debt than positive, right, or compound. Where would you recommend starting? What's the starting point? Is that the financial planning state, like what you were talking about?
I would say so. Like, I would encourage anybody to start with an analysis, because here's the thing about any financial professional. It would be unethical for them to make a recommendation if they don't look at the big picture of what's going on, because you have
Yeah.
different assets sitting in different places. There are different things that are working in whatever direction they've been aligned with. And getting a picture of what all that looks like for you will allow them to determine, hey, what's the most effective way to eliminate debt? You know what I mean? What's the best way?
Yeah.
Because there's different ways to go about it. You know what I mean?
Yeah. And then you made a good point earlier. You mentioned you're 100% with the VA, right? And many of the military is. Is there any resources there that can be utilized and kind of merged in with what you're talking about?
That's a good question. Um, the VA has a lot of different resources. What I've come to find is that, like, even for, like, I'll just bring up the life insurance component, because we get out, we lose the SGLI, we get the VGLI if we want it. There are better life insurance products than the VGLI, period. There may be some cases where that could be a better option for somebody who wouldn't qualify for some of those other options. But me, I'm 100% P&T, and I got the highest, rating through the insurance for the insurance products that I have. So I didn't have an issue there. That doesn't mean that everybody's going to be in that same boat. So that's
Right.
one example. And I'll give you another example. I'm just gonna shoot you straight. Because even out
Yeah.
here at Fort Carson a few years ago, when I started in this industry, I started working with Gold Star families because the financial professional that was designated to work with them on post was telling them that they didn't have enough money to work with them. That's crazy to me. And so I'm not the biggest fan of what's provided by. I'm not the biggest fan. And that's just my personal experience. That doesn't mean that there's not somebody at some military installation who's great and wants to help everybody and will lean in. I know for
Right.
me personally, I haven't seen that here. So it depends on who you're working with at your VA or at your military installation. I think that's the appropriate way to answer that question.
Yeah. No, that makes sense. Totally.
Because not all professionals are built the same. Like when it comes
Yeah.
to finance, yeah, I learned a lot about this industry when I stepped into it. And there's three major lanes. There's banking, securities, and insurance. And people typically pick a lane, right? And they'll go find a company because there are hundreds of companies within each lane. And they'll go find a company and they're captive to that company, which means they can only provide that company's products and services. So if there was something that was out available in the industry that was more effective for the individual, the person wouldn't even know about it and they wouldn't have access to it. Even if they did know about it from prior experience, they wouldn't have access to it. Now, that's not saying that each company doesn't have a particular niche that they may serve most effectively, but that does mean that if they are limited to one company, that size is not going to fit everybody, period. And so, as I started in this space, that's why I personally started working with somebody who's more of a broker with access to the broad swath of what's available so they can go find, like, hey, what's best for me? And so, again, I would encourage you guys to do that. Just like I'm sure when you guys are working with people who are buying a house, you may tell them, I mean, you may work with a specific mortgage professional, but I know it's wise to go and get quotes. It's wise to talk to people. And I think finance is the same way. Go find somebody who resonates with you and who can find what's best for you.
Yeah. That makes sense.
Yeah.
And then, I mean, just kind of going down the real estate world, what is your recommendation when it comes to financial management as far as like owning properties? Let's say there's a real estate company, or a realtor, or even a real estate agent that has investors, right? Like, how does that look for them?
That's a really good question because I work very heavily with real estate investors, and as a matter of fact, here in like an hour, I'm hosting an event with a bunch of real estate investors.
Like,
What I learned when I came into this space was that traditional finance was telling us to put our money in a managed account where we're making 6 to 8% and we're paying 1%, and that just didn't make a lot of sense. But there are financial strategies that very much complement what we could do in the real estate space. And here's the thing: real estate is a fundamental component of a healthy financial portfolio. You are owning that is a part of the American dream. You are owning a part of this country. So I'm a huge advocate of, buying and owning real estate. That's very, very important. But again, there are financial strategies that very much complement what we can do in that space. There are capital maximization strategies that allow us to leverage the same dollar twice, meaning you can have money in an account gaining interest for you. You can borrow that money from that account and go leverage it to make an investment over here, but you're still gaining interest on the principal over here. You know what I'm saying? So there's a lot of ways to play that game very intelligently. And if you work with a professional who knows what they're doing and knows the complexities of those types of strategies, it can be very, very beneficial.
that's good to know. I know I get a lot of people that ask those questions. How can we move money around, put it here, put it there? And so I think that's definitely good strategies for somebody to come in and actually talk to Nathan and kind of get that information. So,
Yeah.
but
I'd be happy to share insight, especially on the structure of some of those, because they are complex. They are.
yeah, yeah. Well, Nathan, I know that we took up 45 minutes of your time and we appreciate your time here. And I learned a lot in these 45 minutes. And so I know that a lot of people will probably be reaching out or at least having questions. So I thank you for your time, though.
My
And
pleasure. My
I'll let you.
pleasure. I put my name and my email address and my phone number in the chat. I know somebody else has it. So guys, please don't hesitate to reach out. Again, I'm a resource.
Yeah, for sure. Well, thank you again. And we'll definitely be in touch.
All right. Take care. Thanks, guys.
Have fun.